Record high stocks usually equates to record high worry for investors. So in this week's fastest 4 minutes in finance, where we get stock market growth in the next few months may be changing. Hello, I'm Scott Inman. Hey, the S&P 500 index has been up for 8 straight weeks. Since the most recent low on March 30th, the stock index is up 18% in just 39 trading sessions. Simply put, we are on a tear. And despite the doomsday sayers, the stock surge is not coming out of thin air. According to LPL Chief Equity Strategist Jeff Buchbinder, first quarter earnings growth for the companies that make up the index is tracking at an astounding year-over-year rate of nearly 28%. And it's not just the so-called Magnificent Seven stocks that are driving that growth. Excluding the Mag 7, the remaining 493 companies that make up the index are still expected to be up nearly 20%. As we've said before on this segment, the fundamentals of the companies that underpin the index are strong. And the case for continued growth is strong. But there are reasons to be cautious in the short term and reasons to remain diversified. As we know, technology is driving growth. The artificial intelligence build-out and implementation will continue to drive it. So the question is, where will the stock growth be? Will large-cap tech continue to lead the way? Or is there a reason to believe a rotation to other stocks is coming? Our partners from LPL Research did some technical analysis to give us some guidance on what could happen next. And one of the ways they did that is to analyze how many stocks are outperforming the broader index. In other words, if you take the performance of the S&P 500 index and compare it to the performance of each individual stock that makes up the index, how many of them are doing better than the overall index? Well, take a look at this chart, and you can see the historical average over the past 20 years is about 50%. Half the stocks in the index typically outperform the overall index. Right now, though, it's only about 33%. And as you can see on the chart, that's approaching historically low territory. So that could suggest a broad market rotation is coming. In the past, when the outperformance levels got this low, large cap value and small cap stocks outperformed over the next 1, 3, and 6 month periods. So LPL cautions that a short-term pullback in the index could be on the horizon. So what does this mean for investors? Well, the long-term outlook for stocks remains solid, but if you're going it alone on your investments, these are all good reasons not to. Over-concentration into the hot stocks of the day can cause a bigger drop to your portfolio than working with a financial advisor to create a diversified portfolio with ongoing management that can make changes that could help you potentially minimize loss and take advantage of market rotations.
Want to become smarter financially in 4 minutes or less? Sign up at fastest4.com to get insights and updates like this delivered to your inbox weekly.